The next decision that we're going to look at is joint product decisions. When we make joint product decisions, we can get multiple products called joint products from a single raw material input. This is dependent upon our industry and what kind of products we make. So, for example, maybe when we're processing cocoa. So we're in a chocolate company and we process cocoa, we can make baking cocoa, or we can make chocolate syrup, or we could make hot chocolate, or we could make bar chocolate, but it all comes from the first process of the cocoa plant that we get in, which is the single raw material. Another joint process that's popular is lumber. So we get in raw lumber and we can make multiple different pieces of lumber. We can make 2x4s from it, or we can make other pieces of lumber from it. The point in the manufacturing process where we split off, so where we move from the processing to where joint products can be made, is called the split off point. At the split off point, we make that process, sell, or process further decision. So for example, if we're processing cocoa and we turn it into powder, that sell or process further decision happens there. So we can sell the cocoa powder at that point, or we can process it further into a different product. So we look at the joint cost. So those are the common costs that are part of the processing to get to the next point. So in this example, we have petroleum. We have a large number of products that are made from crude oil. So we start with crude oil. There's a common production process. We get to the split off point. From that split off point, we can make oil, or we can make gasoline, or we can make chemicals. The gasoline we sell, but with the oil and the chemicals, we have additional processing that need to happen before they can be sold. When we try to make that decision, we have to allocate those joint costs. So we allocate them among the different products at the split off point. We have multiple ways we can do this. One of the ways we can do this is to allocate joint costs according to the sales value of the end products. The allocation is needed in order to value our inventory for our balance sheet and cost of goods sold valuations, but it is difficult sometimes to make these allocation decisions, much like it's difficult for us to make overhead allocation decisions. But it's important because it's part of our cost allocation for inventory and cost of goods sold. And it's required under US GAAP for us to do it, to do that full absorption costing. Joint costs are irrelevant when we're deciding if we're going to sell or process further. So those costs should not be allocated to end products for the decision-making process to sell or process further. We're going to continue processing a joint product after split off as long as the incremental revenue from the processing exceeds the incremental costs after the split off point. We're of course going to look at an example. So we have a sawmill. They cut logs from unfinished lumber, and sawdust are the immediate joint products. The unfinished lumber can be sold as is or processed further into finished lumber. Sawdust can be sold as is to garden wholesalers or processed further into Presto logs. So we have lumber and sawdust. We have the sales value at the split off point and the sales value after further processing. We have the cost of further processing and allocated joint product costs. So we look at the final sales if we do the further processing, $270 or $50. The incremental revenue from further processing. So remember, the incremental is the difference between the two decisions. We can either sell it at the split off point for $140 or process it further and sell it for $270. So the difference between those two is $130. The cost of further processing the lumber is $50. So we make $80 extra if we pay that extra $50 to process further. The sawdust, however, we lose money if we pay to process it further. So the lumber we should pay to process further, and the sawdust we should sell to the garden centers at the split off point instead of making it into a new product. Activity-based costing can be used to help identify relevant costs for decision-making purposes. Of course, we have to be careful anytime we're looking at doing this because we need to make sure that there's actual traceability in costs. We might assume that if a cost is traceable to a segment, then the cost is automatically avoidable. This is not always true. So we need to know which costs are actually avoidable and which costs can't be avoided. This is one of the reasons that we spent so much time on cost allocation before we get to these decision-making chapters, because we need to really know what cost behavior is before we start making decisions about how we can or can't cut them. The last part of chapter 13 is in pricing decisions. So I didn't include, this is all in the appendix, and I didn't include this as part of the chapter 13 homework and the Learn Smart quizzes, but it is interesting information, and we've talked about pricing a couple of other times. So it's good vocabulary to have, and it's not to say that you won't eventually see problems from these. So pricing decisions. When we're thinking about pricing decisions, we get into economic concepts. So our customers, our competitors, and cost. Customers have information and the ability to choose between different things. That can complicate the pricing process. They might not have the same willingness to pay for a particular price for a given product. So then we want to know about the price elasticity of demand. So now we're getting into our econ concepts, price elasticity. So this is the degree to which the unit sales of a product or service are affected by a change in unit price. So demand for a product is inelastic if a change in price has little effect on the number of products sold. Demand for a product is elastic if a change in price has a substantial effect on the number of units sold. So as a manager, we want to have the highest markup over cost when we have inelastic demand, and lower markups over cost when demand is elastic. Competitors have an important effect in companies' pricing decisions because they provide the reference prices that influence the price elasticity of demand. So at what point is a customer willing to pay for our product before they'll go to a competitor for a cheaper price? Customers and competitors play important roles in determining the price ceiling for our products and services. Our price floor is determined by our costs. So if we price all of our products above the price floor, we don't guarantee that we're going to earn a profit. We want to make sure that we price in such a way that customers are still going to purchase our products. There are multiple different ways to price. We've talked about cost plus pricing in a previous chapter. So this is where we use a markup. rate. We take our total cost and add a markup percentage. So in this example, we want a 20% markup over cost, and the cost of making the product is $50, or the cost of buying the product if we're a merchandiser and we don't manufacture. Then our selling price would be $60, or whatever the 1 plus the markup percentage times our cost is. For cost plus pricing to work, we need to know the full cost of our unit products. That's all costs: materials, labor, manufacturing, overhead. We need to determine our markup percentage. We then need to multiply the product's unit product cost by the markup percentage. We assume that customers are going to pay whatever price we decide to charge. This is, of course, is not always the case. It depends on the product. Sometimes customers will pay whatever the price is. But sometimes they'll just go to our competitor. So in this example, we've determined all of our costs. We have the unit product cost of $20. We're going to use cost plus pricing. We want to mark up high enough to cover all of our selling and administrative expenses and to provide an adequate return on investment. So we add our total selling and administrative expenses and what our markup is. We require a 20% return on investment on all investments. So we're going to use that 20% as our minimum. This gives us a markup percentage over cost of 50%. So then we take our unit product cost of $20, add a 50% markup, and get a selling price of $30. Customer latitude recognizes that customers can purchase a competitor's product or allocate their spending budget to something else altogether. We have to take this into account when we're setting prices. In this example, management is considering increasing the price of our shampoo from $5 to $5.50. We are aware, however, that this 10% increase in price will result in a decline in sales because of the latitude that customers have in purchasing decisions. They can buy different shampoos on the market. They might not be willing to pay the extra 50 cents. In this case, an increase in price is actually going to cause a decrease in volume that affects our total profit. So our current profit at $5 is $30,000. If we increase our price and reduce the number of customers buying our product, we're going to lose profit and market share. So based on our calculation, we know that increasing the price actually reduces our profits because our sales are going to decrease by 15%. If sales decrease even more than we predicted, there would be more financial implications. So then we would look at what are the financial implications of our sales decreasing further. We can use Excel to make predictions about what our optimal pricing is based on, so we have this, we're using the Solver add-in. We're calculating an optimal price for any product or service once the percentage change in price and percentage change in unit sales have been specified. So we're assuming a 10% increase in price causes a 13% decrease in unit sales. That means our optimal pricing model calculates an optimal price at $6.34. So this is a solution finder, that Solver add-in that you can use in Excel to make this prediction. The last pricing model that we're going to talk about is target costing. Target costing occurs when the market determines the price of a product. So this means that we don't have flexibility in the price. So we have the anticipated selling price minus our desired profit, and that gives us our target cost. And our product development team then is responsible for designing the product so that it can be made for no more than our target cost. So target costing is used when the market determines the price, supply, demand, elasticity, and inelasticity, and when most of the cost of the product is determined in the design stage. So this is part of product development process where we're recognizing and responding to existing market prices. Other approaches allow engineers to design products without considering market prices, but we know that in a competitive industry that the market will set our prices for us, or we'll have a point at which our customers are no longer willing to pay more money. So if we want a specific product margin, then we want to reduce the costs in the manufacturing and design process. In this example, we have a hand mixer with special features. We believe a price of $30 would be about right, and that we would have market demand for 40,000 mixers at that price. An investment of $2 million is required before we can do production with these hand mixers. We require a 15% return on investment. So we have our projected sales of 1.2 million, our desired profit of 30,000. That gives us a target cost of 90,000. That means our target cost per mixer is $22.50. That is the cost we're going to give to the engineers designing this product. And we're going to ask them to incorporate parts and manufacturing processes that keep that cost at or below $22.50.